I have a few charts to go over tonight. The first one I'm going to go over is the S&P 500, and this is the S&P 500 cash symbol. So this is not the SPY ETF. This is the SPX or S&P 500 cash. And what happened today is we broke the May 2nd high. So here was the May 2nd high, and today we exceeded that high by about 1 point. And I had talked in some recent videos about the fact that it would be ideal to see that high broken before a reversal. As the market rallies in a case like that after this downtrend, any chart-based traders and algorithms and things like that will be placing stops above highs of prior resistance there, and that's obviously the most pertinent relative recent high, and so you'll get a lot of stops placed above that level for any short attempts in through this area here. And when the market actually comes up and it exceeds that high, it'll run the stops typically, run the buy stops. You might get a little spurt of buying, and then a reversal down. So there's a possibility that this could set up a double top chart pattern where you have, if this click out to a weekly chart here, where you have a long rally here, you have a high, market comes down, market comes back to that high at the same level, and the chart target for a double top pattern is to take the high down to the low of the middle of the double top and project that down from the break of that low, the intervening between the double top there. So that would be a pretty big move. That would imply downside, somewhere down into these levels down here. So we don't have any confirmation that's the case yet, but that's a potential chart pattern to look at there. Another thing is these lines, these vertical lines here on the chart. This blue line is showing the time from the May 2nd high to that October 4th low, basically. And then if you double that, that would put us at March 7th. So that will be when the time is equal to this high to that low, which could be a significant time frame. And then from the October 4th low to this December 19th low right in there, where I view this as an A and then a B type of pattern there. If you add the time of those two together, project that out from this point here, that basically perfectly overlaps around the 7th or 8th of March. So we have a couple factors suggesting that could be a time resistance zone. Now I'm going to show some other charts that are pinpointing that exact time frame too. So I'm thinking there could be a significant turn here within about a week. I'll show a US dollar chart or euro chart and a gold chart too that would suggest that same thing. Now this is the Dow. There were two back-to-back dojis, and today with a significantly wider range. Since the Dow exceeded that May 2nd high a couple weeks ago, it hasn't made any type of convincing breakout type of move. There's this bearish divergence on the MACD relative to the Dow here, and there's a bit of a wedge within a wedge here in the Dow. So again, if looking to short, if we get a break of this trend line on the Dow, so if we get a close below that trend line, that would be a possible short signal. If we want to wait till that March 6th or 7th time frame prior to shorting, that might also be a good idea to let that time factor play out before shorting. This is the Russell. Again, I'm suggesting that I'm looking to trade this shorter inverse on the break of this trend line right there. This is a chart of Apple. I showed that a week or so ago here at this big bearish engulfing pattern showing reversal, and I talked about the fact it's bumping up against some longer term trend lines there, so it could be a reversal area. And what I had said is that the market may pull back slightly and then come up to make a slight higher high, forming a divergence on the technical analysis. That's exactly what's happening right now, and it's actually a very, very ideal looking divergence to form some degree of a top. it may need to decline and then actually move to a new high again before this forms an ultimate top. But in any case, it could be at a major high here, but the technical analysis is suggesting that this attempted breakout of that high from a week or so ago might be a failure, and we might see a move back down at a minimum towards this support level before another attempted move up there. So that's just another hint that the market may correct here. We don't have any type of cross down yet, so it could break up through that level. But if we see this stochastic roll over, if we see price fail to break out of this high on a closing basis convincingly, that would at a minimum target back down towards that level there. This is a chart of the Euro-US dollar currency pair, and I really view the US dollar and that relationship as the driver of the markets. That's really what's going to reflect risk in the credit markets and the whole deflation and inflation type of scenario. So by watching that, that tends to lead the markets. The US dollar will tend to lead the markets as the euro falls relative to the dollar. We'll tend to see the stock market fall too. And what I'm looking at here as far as another time factor is this is potentially an A, B, C pattern in the euro. And this green line here is the projection of that A move. Now, when the A move is relatively short, the B move is relatively long. The time of the C wave, the most ideal time for it to end, is to take half the time of those two combined. That's what this box, this gray box here, represents, and that would put us at March 6th. So we're about a week off here from that time factor. A couple other things to note here. This red line here and this dotted red line here that shows the 61.8% retracement of this move down, and that may be an ideal area for a top, so may see this continue sideways to up for another week or so there. Watching the break of this trend line right here could be a signal, a confirmation type of signal that the upwards move is over. The stochastics is overbought down here on a daily time frame, and on a weekly time frame I like to use the 8-period stochastics for counter trend movements, but the 8-period stochastics is also overbought on that time frame there. The other thing I wanted to point out on this chart is that this dotted blue line here is the 138.2% retracement of this move up, what I have labeled the A wave. Now, in a flat pattern, if the B wave comes down and retraces more than 138%, 138.2% of the A wave, if it is truly a flat pattern, then it will, by rule, not break that high. So we're running into time resistance, so time is running out for this pattern to complete, and we basically know that if this pattern is correct, it should not move above that high. The ideal would be for this move to approximate the size of the A wave, and that would suggest a move up towards this dotted red line there prior to the top. So we may see the euro push up a little bit higher. That would suggest that stocks may push up a little bit higher as well, but we don't know that. The market could top any day here. It could kind of channel off here before rolling over. So that's my take on the euro right there. This is gold, and what I have suggested here recently is we are looking for a breakout of this high in gold, which we got middle of last week, and then for a possible trade signal would be for it to break out of that level and then fail and close back down below that level. We haven't seen that yet. Gold showed some slight weakness today, but I would continue to be on the lookout for that. With a possible way to trade this is, let's click over to the GLD ETF. We had a bearish cross in the stochastics today, so if we get another down day and that rolls over, you could have a short entry with a stop, a buy to cover stop right above that high there. It's a pretty tight stop. Would be risk taken out. You don't have a lot of confirmation the pattern is done yet, but with a reward potential down easily below that December low, that would be a reasonable trade right there. Another thing to look for is allow this market to actually come and confirm by breaking this low here that this up leg is likely done. So allow it to confirm that, and then hopefully get a secondary rally prior to a bigger move down. I don't know that that will happen if this is a high here. We may see something more akin to what happened here, where you had a high, maybe a sharp break and a day or two rally, but I don't know if we're going to get an ideal decline and then a nice secondary rally to short it at. So my inclination on this is to take the trade signal that comes here to go inverse or short gold on that. Now, as far as the time factor here, from this point here, January 31st to basically March 28th, those about 80% of bear market rallies in gold should top in that time frame. The dead center of that time frame is somewhere right around within the next couple of days here. That early first week of March time frame as well, which the stocks potentially pointed to a turning point, as well as the euro. So again, that's another reason I'm looking at as a possible time frame resistance here, so be on the lookout for that as well. Another thing I wanted to point out in gold is that the average leg down in gold in history in a bear market is approximately 4 months, approximately 20%, give or take a few days and a couple percent there. And what we had down here was basically a 20-day move down on this first downward move, and then a rally, which was a pretty typical bear market rally. And then we saw November 8th to December 29th, so 1 month and 20 days, which is also a pretty short leg down. And now we've had another nice rally, a pretty typical bear market rally so far. So we had two very short legs down. If you look at the total time of those from September 6th to December 29th, that's about 3 months and 23 days. That's really close to a typical bear market leg down in gold as far as time. So while these rallies suggest that these could be individual legs down, I think it is also potentially sensible to view this as an initial leg down and then look at this as a correction of that. If so, this lighter box up here represents what would be the ideal topping time frame in price and in time for that bear market rally, and we're right in the dead center of that now. So as we start to move through next week and come towards the latter half of that, it's sensible to suggest that if this is a continuing bear market rally in gold, which all of the ancillary data as far as smart money, commitment of traders, those type of things all suggest that, then we should be entering a time frame where it's more safe to short gold as we move past the middle of that box there. This is a chart of the TLT ETF, which is a long-term U.S. Treasury bond fund. And while I've suggested some posts that this is a long-term, very overbought, and could see a dramatic bear market to come, and you may even consider it a generational or multi-generational bear market, I still believe that's the case. However, right now, we're not getting any confirmation that that's happening yet. And in fact, we've had a series of lower highs down here since December. So we had this high here, we had a lower high here, we had just a slightly lower high here, another lower high here, another lower high here, and then today we broke out above that high with a gap up after a very mild potential divergence down here in the MACD indicator and on the shorter term charts. So because of the inverse relationship between bonds and stocks typically in this market environment, if that breakout holds, that's a suggestion that the bonds will continue higher, likely take out that high from October. And if that happens, we would expect the stock market to correct. So we may be seeing the stock market correct here as of this week and next. But that's something to be on the lookout for here. Now, longer term, once that breakout happens, let's say we break out up into this level, the expectation would really be for some type of a failed breakout, and then possibly a major top in the bond market. So we'll have to see how that plays out, but longer term, that is my suggestion. I think that's what the size of these moves and the historical data would suggest on that. But you know, there's a lot behind the scenes going on to support the bond market. Some that we're aware of, and I think probably a good bit that we're not aware of publicly too, as far as intervention from the central banks and that type of thing. So I don't know this is something that I'm that interested in shorting unless there's another really nice signal when that comes up, probably using a weekly time frame chart. This is a chart of oil. This is a daily nearest futures continuation chart, and we've really had an amazing move in oil here over the last week or so. We've actually, prior to today, closed outside the upper Bollinger Band for 7 days in a row. I've gone back through several years of data on the USO ETF and some oil futures contract, and that has not happened in years. Now, there were some times where you had 3 or 4 or 5 days, and it didn't always imply any major type of top. Typically, you'd see a pullback after that or consolidation. But the analogy I've drawn on this pattern is a little bit larger, but similar to what happened in stocks this past winter and into the summer. And on the last few days prior to the high in stocks in July of this past year, we saw, well, I believe it was 5 days in a row, closing outside the upper Bollinger Band into that July high before the market dipped, had a slight rebound, and then majorly tanked after that. And I believe a similar thing could happen here in oil. However, in the short term, there's a bit of an ascending triangle pattern here. So we had an upper resistance line between this line, and then we had a rising lower line, and it broke out of that last week. The target for a typical ascending triangle on the chart would put it right at basically the high on this bull market for gold, which would be that April high up there. The pattern here does retrace, if we look at this as an A and a B and a C move, does retrace the entire A wave, but it doesn't go more than 138.2%. So it is possible, based off that pattern, even if the pattern is accurate, so to speak, that the market does come up and slightly take out that high, but it should not break out of that high. The COT data on oil right now is showing that the large speculators, which really drive the trends and the ability to break the markets out, is very close to how high it was in April. So they're close to their maximum historical long position, which suggests that they don't really have any more funds available to push the market higher. So unless a situation develops where the market can push up here and force a relatively large and maybe sustained short covering rally by the commercial traders, we should assume that the market will fail to break out here and would possibly lead to a very significant decline. Now, the pattern I had showed over the last couple of weeks has possibly a 1, 2, 3, 4, 5 type of a terminal impulse there is not valid anymore. This move up here is too big. However, there's another way to look at this. Let me click over to that here. Is based off the time frames of these to now look at this move as like a W or wave in Elliott wave terms. This is possibly an X and then an ABC upwards flat pattern. If that was the case, that would really put us at Wednesday as the ideal topping time frame for this pattern, so the next day or two for an upwards flat to complete. If that is an upwards flat from here to here, then this C wave should be completely retraced in less time than it took to form. It started on February 2nd. Let's say it ends February 29th, so that should mean in less than 4 weeks that should be completely retraced. So I don't know if that's what's happening here. However, the price logic would suggest that whenever this breakout is complete, we'll probably see a very large and fast decline back towards support in this oil market. This is a chart of silver, daily nearest futures continuation chart, and basically I wanted to point out on this is that silver did slightly eclipse the high from October here. Gold did not yet, so silver is showing some relative strength to gold on this move, and while the implication is still that silver is very likely to move down, especially as we start to enter the next couple weeks time frame here. These lines here are projections of some prior bear market rallies in silver, with a number of them happening by first week of March again, so that date keeps showing up. The projection is still for a retest of this low. However, this did completely retrace this move down in slightly less time than it took to form. So it is possible that we could be seeing a significant low already in silver with a retest of that low. I would lean towards that not being the case. However, I have to respect that as a possibility there. The shape of this bear market thus far is similar to a bear market in silver in the 1970s, which ended kind of like that, with this move exceeding this corresponding high, retesting this over the next several months, and then forming kind of a sideways range before ultimately breaking out in another big bull market. So something to be on the lookout here if you're following silver. This is the last chart I'm going to show. This is a chart of the McClellan Oscillator, and I've showed this off and on the blog. It's basically a measure of breadth in the market, and breadth being how many stocks are advancing versus declining and that type of thing. The McClellan Oscillator, on its rally up from late November, peaked out on January 25th. It put in a lower divergent peak on February 3rd, and now it's hovering down here actually below zero, as the market is still pushing to new highs. So there is an absolutely massive bearish divergence between the McClellan Oscillator and price here. Now, one way you could view that is say the market's taking a breather, it's consolidating, set up for another move high. The other implication is that there's just a really, really tremendous bearish divergence happening between price and breadth, and the market is very, very close to a significant sell-off. That's what I believe is likely the implication on this. There are all kinds of divergences showing up in the market. This is showing that there's divergence in breadth. So the number of stocks making advancing and declining each day is showing divergence. If you look at a chart of the number of stocks making new highs each day, it's showing divergence. Both shorter term within this rally and longer term to prior peaks within this bull market. If you look at the VIX, despite the market making higher highs recently, and the VIX theoretically should be making lower lows, it has not, so there's a divergence of volatility. One chart I'm not going to show here, but the equity put-call ratio and the total put-call ratio, they have already turned higher. They peaked, they hit their trough as the market in the first week of February, and they have already started to turn up. They typically will turn up prior to a market high, so they're not confirming the rally. They're starting to diverge from the rally. And then just the price-based oscillators and indicators themselves are showing divergence. So you basically have divergence on every type of market data that we can use to track the market and the health of the market. And the smart money data from the commitment of traders, which I've talked briefly about, showed a major sell signal on the NASDAQ within the last couple weeks, and some minor sells on some of the other indexes. But the implication there with a major sell being that it could lead to a bear market in stocks. That's what major means. So I think we're coming up on a possible time frame here within the next couple weeks where we could start to see some things top out. So that's really all I wanted to go over in this video, but the implication if the bull market is completing here, it would be for a very large, very fast move down within the first couple months off the high. So if this analysis makes sense to you, if you are long the markets, if you are long investments, hopefully you've already thought about exit strategy and that type of thing, or hedging strategy or whatever, but this would be a time where I would say it's just a screaming get out or hedge or whatever you need to do to make that work. But at this point in time, there's just a tremendous amount of downside risk in these markets. So take that or leave it. That's all for this update. Have a wonderful week.